Hello and welcome to the eighth episode of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. In this podcast, we'll dive into the latest M&A activity, upcoming spin-offs, significant buybacks, unique insider buying, activist campaigns, and a whole lot more.
My name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
And my name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area. This week, we will briefly discuss the acquisition of Bridge Investment Group by Apollo Global Management, the spin-off of SanDisk from Western Digital, as well as the spin-off of Resolute Holding Management from CompoSecure, which quite frankly was a fascinating spin-off as I dove into it deeper. A stock buyback announcement by the largest egg producer in the country, an insider purchase by the CEO of MSCI, and multiple sudden C-suite departures.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Let's begin our podcast with a discussion of a potential merger. CEO Anne Wojcicki and New Mountain Capital submitted a proposal to acquire all the outstanding shares of capital stock of 23andMe for a cash consideration of $2.53 per share. The stock is currently trading at $2.20 per share and has lost more than half of its value since last October when the stock underwent a 1-for-20 reverse split. Their pivot to a drug discovery from a genetics testing company did not go very well in recent years. The market cap is $59 million and they have $79 million in cash on the balance sheet. They also have $61 million in capital leases and $66.5 million in accrued expenses.
That's an interesting deal if it actually goes through. Last week was very slow on the announced M&A front with just one new deal announced. Apollo Global Management is acquiring the real estate investment firm Bridge Investment Group in an all-stock deal valued at $1.5 billion. Apollo, the massive private equity and alternative investment manager with over $750 billion in assets, usually buys companies with cash for its investment portfolios. So this deal was a little surprising because it was structured as an all-stock deal. The deal is a little different from the standard Apollo deal as it is being done to help Apollo's real estate portfolio increase from $77 billion to $110 billion post-acquisition.
Apollo paid a healthy premium of 45% for Bridge, but given the all-stock nature of the deal, it's going to be very accretive to Apollo. Apollo's market cap is $85 billion. Considering Apollo's assets under management of $751 billion, this implies that the market is valuing the company at about 11% of its assets. In contrast, Bridge's AUM is $50 billion, but the deal value is just $1.5 billion, which implies a value of just 3% of AUM. Granted, this is a very simplistic way of looking at things because real estate assets usually come with a corresponding large debt load. Moreover, only $22 billion of Bridge's $50 billion in AUM generates fees.
However, the business is broadly diversified across strategies, and 18% of the fees come from fund management. These funds range from traditional multifamily, opportunity zone, and office funds, but they also have several large debt funds with nearly $5 billion in assets. Overall, I think this is a very attractive deal for Apollo, and the use of stock to purchase Bridge makes perfect sense.
We'll wrap up our M&A section by providing a few updates on a developing deal that we've discussed in prior episodes. When we last covered QXO's hostile bid for Beacon Roofing Supply, we discussed how Brad Jacobs and QXO had nominated 10 independent director nominees for Beacon's board, and furthermore managed to obtain antitrust clearance in both the United States and Canada for their acquisition of Beacon. The tender offer to acquire all outstanding shares of Beacon was set to expire on February 24th.
I'm still quite shocked that they already have all the regulatory approvals in place for this deal that has not even been finalized. These aggressive moves on QXO's part, surprisingly enough, didn't move the needle all that much in terms of the tender offer. QXO announced a few days ago that they'd extended the tender offer to acquire shares of Beacon until March 3rd, which is basically Monday when this podcast comes out. When they last talked about the tender offer, about 10.69 million shares had been validly tendered and not withdrawn, representing just 17.27% of the issued and outstanding shares. As soon as the tender offer was announced, the deal spread jumped to 7.65%, reflecting the market's uncertainty that this tender offer will work out in favor of QXO. We dove a little bit deeper into this situation in our latest March Special Situations newsletter on Inside Arbitrage.
Moving on to spin-offs, we had two new spin-offs last week. The hard disk drive company Western Digital completed the spin-off of its flash division SanDisk, a spin-off that we actually discussed in prior podcast episodes. Shareholders of Western Digital received 1 share of SanDisk for every 3 shares of Western Digital. SanDisk was set to get included in the S&P Small Cap 600 index the day following the spin-off. Western Digital is essentially flat since the spin-off, but SanDisk is down almost 4% following the spin-off on concerns about weakness in flash memory prices. Both Wells Fargo and Raymond James initiated coverage of SanDisk with an equal weight and market perform ratings, respectively.
I'm still holding on to my shares of SanDisk that I received through the Western Digital spinoff. Let's see how it plays out over the next few months. The other spinoff we saw last week was the high-end metal payment cards company CompoSecure, spinning off Resolute Holding Management. Shareholders of CompoSecure will receive 1 share of Resolute for every 12 shares of CompoSecure they hold. So potentially a tiny position is what you would end up with if you participated before the spinoff. Just days before the spinoff, CompoSecure stock was already up more than 300% before it actually dropped recently. So I was looking at that 300% run up in the stock, and I was curious if the famous Robin Hood gold card that is made of solid gold is manufactured by CompoSecure. And that was indeed the case. CompoSecure does manufacture the Robin Hood gold card, and they also make cards for American Express, JP Morgan Chase, and interestingly enough, Turkish Airlines.
This is an unusual spin-off because the entire investment team of CompoSecure will move to Resolute Holding Management, and Resolute will charge a 2.5% management fee to CompoSecure. This 2.5% management fee will be on CompoSecure's latest adjusted 12 months EBITDA to create a recurring revenue stream for Resolute that it plans to use for acquisitions.
This reminds me a little bit of Bill Ackman's proposed deal for Howard Hughes, where Pershing Square would charge a 1.5% management fee on Howard Hughes's market cap for services rendered for hedging and capital allocation. Going back to Resolute, I was curious to see why they would charge this 2.5% management fee, and I noticed that it had David Cote, and I hope I'm saying the last name right, as its executive chairman and Tom Knott as its CEO. I was trying to think about why the name David Cote sounded familiar, and then I realized that he used to be the executive chairman and CEO of Honeywell. Elliott Management referred to him in their letter to Honeywell and had this to say, and I'm quoting this verbatim. Honeywell in its current form traces its roots back to the 1999 merger of Honeywell and Allied Signal. That combination created a complex, conflicted organization which fell into further disarray after its proposed acquisition by GE in 2000 was ultimately blocked. From that challenged state, former CEO David Cote executed one of the greatest turnaround success stories in corporate America. Years of Cote's portfolio shaping and visionary leadership helped Honeywell secure great positions in good industries, as he often put it. This is some high-level praise coming from Elliott, and I plan to keep an eye on Resolute.
There we go. We once again managed to weave Elliott into our episode.
Yeah, I went back and checked, and we have already talked about them in 6 out of 8 episodes thus far. Let's see how many more episodes we can keep weaving them into, as long as it's relevant to the podcast. Let's switch now to stock buybacks. When living in Oregon a couple of decades ago, there was an ad that used to play on TV constantly that said, eggs are cheaper in the country and so are RVs. While the RV part might still be true if you went outside the city to find an RV, the eggs part is no longer true. The price of eggs has skyrocketed in recent months after flocks of chicken were culled because of bird flu. This has caused the national average for a dozen grade A large eggs to jump, and they were almost $5 in January. And in some parts of California where we live, the price is closer to $10 a dozen. In the face of such adversity, you have to learn to stay calm, but that is not what investors of Cal-Maine Foods have done. They bid up the stock of the largest egg producer in the country so much that the stock doubled over the last year before dropping nearly 20% in the last couple of weeks. The best part of the whole thing, the stock symbol of Cal-Maine Foods is calm, and it scores 90 on a IA score quant model once I remove momentum factors. These elevated egg prices have helped the company, and when it reported fiscal second quarter results in January, it reported earnings of $4.40 per share, which beat earnings estimates by 79 cents. Revenue was also up, as you would expect, 82% year over year.
Didn't you used to wake up every morning and look at egg prices at one point?
Yeah, that was a long time ago when I had a position in Cal-Maine, and every morning I would check the price of eggs, specifically in the southeast part of the United States, from the USDA website.
Last week, Cal-Maine made a couple of important announcements. It announced a $500 million stock buyback representing 11.58% of its market cap at announcement. It also announced that it had entered into agreement with the family of its founder, Fred Adams Jr., to convert their super voting Class A shares into common stock. If the conversion occurs, the company's shares would become a single class with one vote per share. This will reduce the controlling stockholders' voting power from 53% to 12%, while maintaining its 12% economic interest. This could result in the company losing its controlled company status under NASDAQ rules.
So, if this big spike in egg prices didn't get institutional investors interested in this company, losing its controlled status certainly will. The other stock buyback announcement we want to talk about is Sonos, which announced a stock repurchase program of $150 million. The $11 million remaining under the company's existing $200 million purchase expired upon approval of this new authorization.
Sonos may be familiar to some as this was the company that got killed when it redesigned its mobile app, facing significant consumer backlash.
Yeah, and when we say killed, we essentially mean they had a significant downturn in revenue and other impact. The company still very much exists. They said it would cost them $20 million and to $30 million to fix the app issues, and they laid off 6% of their staff. Not only did the stock take a hit, the CEO Patrick Spence resigned in January of this year.
Another company that announced a large buyback was GM, with a $6 billion buyback representing 12.44% of the company's market cap at announcement. Mary Barra has done an excellent job as the CEO of GM, and while a lot of car companies are struggling to keep up with the transition to EVs and competition from China, GM grew its revenue double digits during the last 2 quarters and has blown apart analyst earnings estimates for 10 quarters in a row. You can see this in the stock chart with GM stock up 21% over the last year, while Ford stock is down 22% over the same time period, leading to a 43% outperformance by GM compared to its closest peer.
Don't even ask me about Stellantis, the old Chrysler that makes Jeep and a bunch of other cars, including Maserati, which saw its stock drop 51% over the last year. In fact, the only auto company to do better than GM over the last year is Tesla. And a lot of that has to do with Elon Musk's close ties to Trump. We are starting to see a big reversal in Tesla, with popularity of its cars waning very rapidly in Europe.
Speaking of car-related companies, Cars.com announced a massive $250 million buyback, representing a whopping 32% of the market cap at announcement. Stock is down about 29% over the last year. The issue is that the company's revenues aren't growing, even if it remains profitable and trades at a forward PE of below 6.
I used to have a position in the company several years ago, but it was a perpetual underperformer and I gave up on it. To wrap up a section on stock buybacks, I want to briefly mention a $200 million repurchase announcement by Taboola, representing more than 19% of the company's market cap at announcement. The stock is down 31% this year, but when I look at the cash flow statement, free cash flow is strong and growing. This is the company that has those spammy looking ads at the end of articles that you come across when you read an article on CNBC, NBC, ESPN, the Associated Press, etc. They actually work with 9,000 publishing partners and 18,000 advertisers. And clearly the business is still growing. Both revenue and earnings are expected to grow in 2025 and 2026, and it still trades at a forward PE of just 7.51. So this makes a whole lot of sense that the company wants to buy back stock.
Let's move over to insider purchases. One of the most typical patterns that we see when it comes to insider purchases is that insiders of a company buy shares after a large drop in the stock price, often due to poor earnings results. Zebra Technologies fits that pattern exactly. The stock is down nearly 20% in the last month, largely due to 2025 forecasts not being in line with Wall Street estimates, with tariffs being the highlighted reason for the hit to earnings. Zebra Technologies provides enterprise asset intelligence solutions in the automatic identification and data capture solutions industry, and I find the company to be quite aptly named, considering one of their main business operations is producing barcode scanners. The barcode pattern, with black and white lines, reminds me of zebra stripes, which I hope was the intent in naming the company after all.
Another insider purchase worth mentioning is director David Mott's purchase of the pharma company Ardelyx once again. We discussed Ardelyx in our third podcast episode and mentioned that the company had an FDA approved drug to treat irritable bowel syndrome with constipation. The other approved indication for this drug is for patients who are on dialysis to reduce phosphate absorption in the intestines. This time, Mr. Mott purchased 77,729 shares at an average price of $5, totaling about $400,000. This follows his nearly 200,000 share purchase in January at an average price of also $5 per share.
This week, we saw an incredibly fascinating purchase at an incredibly fascinating company. Chairman and CEO Henry Fernandez bought roughly $3 million worth of MSCI stock. MSCI is a leading provider of critical decision support tools and services for the global investment security. In addition to providing these investment or finance-related support tools and services, the company operates numerous stock market indexes. The most notable of these is MSCI World, which tracks around 1,300 large and mid-cap companies across 23 developed countries.
Henry Fernandez also has an impressive background. He's led MSCI for over 3 decades, and he was a managing director at Morgan Stanley for over 25 years. He also has a private equity background, and all of these combined really check the box of deep industry experience we like to see when looking at insider purchases.
I do want to note that MSCI is short for Morgan Stanley Capital International, and it was actually spun out of Morgan Stanley in around 2007. So you can kind of see the connection between Mr. Fernandez being a managing director of Morgan Stanley and then later going on to lead MSCI. That all being said, this isn't Mr. Fernandez's first time buying shares of MSCI. He last purchased shares in April and December 2024. While the stock is down slightly from his December purchase, the stock has appreciated by over 25% since his larger purchase, worth about $6 million in April. But what's especially interesting is that these purchases over the last year were the first time that Mr. Fernandez has purchased MSCI stock since 2011. considering the fact that MSCI is an excellently operated business with incredibly strong margins and consistent revenue and net income growth over the last couple of years, these purchases aren't all that surprising. The company has also returned value to shareholders in the form of dividends and currently has a dividend yield of 1.12% and through buybacks by a $1.5 billion buyback authorization announced in October of last year.
You and I have seen the founder and CEO of Akamai purchase shares on the open market so many times. What is really interesting is that he almost always starts buying when the stock price dips to the $80 level, which is where it is right now. He purchased nearly $3 million worth of shares last Thursday after a pullback in the stock over the last month. Akamai, as you know, provides CDN or Content Delivery Network services that allows content to be served quickly for users in different parts of the world. For example, we use CDN for inside arbitrage, where even if a server is located in California, a user in Hong Kong can pull up the content from a site through the CDN servers and it would load much faster. Akamai started to see multiple emerging competitors like Cloudflare for its core CDN business, and it ended up diversifying into cybersecurity. The stock is cheap because growth has slowed down considerably in recent quarters.
A quick update on the activist side, featuring none other than our favorite, Elliott Management. Bloomberg reported that BP, or British Petroleum, is set to announce a potential sale of its lubricants business and abandon plans to cut oil and gas output as it embarks on a shift away from renewable energy amid pressure from the activist investor Elliott Investment Management. If Elliott is unsatisfied with BP's moves, the hedge fund may push for management changes, which seems to be their very typical playbook.
What is also interesting to me is they seem to be engaging with a lot of energy company these days. Phillips 66 was another one they were engaged with. So it's fascinating to see that Elliott Management would start focusing on energy company at this part of the energy cycle. Talking about C-suite transitions, Beyond Meat saw its chief marketing officer resign effective February 25th. I was looking at the price chart of Beyond Meat, and during the meme stock mania of 2020 and 2021, they drove the price up about $200 per share. It now trades at $3 per share and change and is down 97% over the last 5 years. The company is continuing to post losses and negative cash flows each quarter. Rival Impossible Foods, with its famous Impossible Burger, had considered going public in 2021 and then wisely decided against it. I guess the fake meat trend is pretty much over.
I will say here at UCLA in the dining halls, there's a lot of fake meat options, especially from both Beyond Meat and Impossible. So it kind of depends on where you are. But speaking of burgers, Jack in the Box CEO Darren Harris left in a sudden departure after nearly 5 years at the company. The stock lost about a third of its value during his tenure. The new CFO, who had just joined the company a month ago, took over as interim CEO. There seems to be a revolving door in the C-suite at Jack in the Box because they have had 2 CFOs, a CEO, a COO, and a chief supply chain officer leave in the last 3 years, which doesn't bode too well for the company's future.
That is significant changes in the management group there. Talking about Lucid Group, the chief executive officer and chief technology officer, Peter Rawlinson, resigned effectively February 21st. He was at the company for nearly 6 years and the stock lost more than two-thirds of its value during that time. He was previously Tesla's VP of engineering and the chief engineer for the Model S. I was looking at investors that have invested in Lucid over the last several years, and Saudi Arabia's public investment fund has invested $8 billion in Lucid over the years, but the company still posts losses and net cash switched to net debt on the balance sheet recently. They make high-end EVs that look amazing and have a long range. I was looking at their lineup of cars, and the Grand Touring version of the Lucid Air has a range of 512 miles, goes from 0 to 60 in 3 seconds, and starts at $111,000. They also have a Sapphire version that costs almost $250,000.
Incredibly impressive, but also very expensive cars then.
Indeed.
To wrap up our C suite section, we'll talk about a sudden departure at the regional bank First Busey. The CFO, Jeffrey Jones, of the company left after 5 years and 6 months, which was especially strange considering that First Busey is in the middle of an acquisition at the moment, and Jeffrey Jones was set to take over the combined company. First Busey stock didn't perform all that well under Mr. Jones' tenure, only up about 15% in that 5 years and 6 months. But the all-stock acquisition of Cross First Bank shares by First Busey for a closing value of about $900 million was expected to add a lot of value to the company.
The termination was apparently not tied to any financial activities or reporting or the pending acquisition, but no other information has been disclosed. First Busey is also a familiar name since we always used to see insider purchases at the company, though most of them were related to dividend reinvestments, which we assigned less weight to or considered to be less of a signal.
And with that, we'll wrap up our 8th episode of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com.
If you like this podcast, please take a moment to like and subscribe on whatever platform you may be listening to, and especially share it with your friends who might be interested in special situations. Thank you.